Welcome to another episode of the Scottish Property Podcast. My name's Nick Ponte. I'm here with Stephen Clark. How you doing, Stephen?
Good, thanks, Nick. Take two. Here we go again.
We're just off an interview with Liam from GetGround, and basically they're a new company, sort of tech company that's been set up dealing with buy-to-let investor landlords if you're interested in investing through a limited company. So they're really interested in the model they've got. It's like a platform. Basically, it takes away the need for, a traditional accountant and bookkeeper and all the rest of it.
Yeah, I mean, it was. I mean, we kind of got them on to talk about a couple of questions that we get asked often is, transferring properties on your own personal name in a limited company. And we knew that, it's quite good. We'll approach them. They're quite big on the educational front and educating people to their consultancy side. But the chat went right into their consultancy, the service they provide, which I think we both found quite fascinating because, they set up on each individual limited company for each individual property you buy in your portfolio, but they manage it all for such a small fee, like you said, all the company administration, the bookkeeping, everything. And I found it quite fascinating because it was a very tax efficient way of exiting the portfolio, or sell the property in that portfolio because it's the only property in that company. So there's quite a lot of tax implications and positive benefits from it.
Yeah, and obviously we're going to be really unpopular with traditional accountants now that we've had these guys on, but it is a kind of example of, sort of innovation within the kind of property accountancy industry. So I think it's definitely something to look at. We'd be keen to hear from any listeners out there who are actually clients of GetGround so that we can understand, if it's something that we would sort of recommend in the future. So if anybody's using it, get in touch.
Yeah, absolutely. And this is, the questions that we asked as well, this is not going to be for everybody. It did seem like it was for more the starting out guys or the ones that were had maybe smaller portfolios, but they are said they're going to work on in the future of how to incorporate and restructure people with already maybe 20, 30 properties in their portfolio already. So yeah, it's not going to be for everyone, that's for sure. But it definitely raised my eyebrows to the service they provide, because there's nothing worse than the bookkeeper and the administration side of a limited company, and have a couple of limited companies. It's a right pain in the arse. So for them to take care of that service, that does sound quite good.
And I guess that's why, likes of Xero and QuickBooks and all the rest of these companies have been so successful, because it makes everything a lot more streamlined. So if they're incorporating that tech sort of system within, the limited company buy-to-let sector, then I can see the benefits. It'll just be interesting to see how it's working for people. So
absolutely. And one thing else he did touch on, which was we found both fascinating as well, was the exit plan for, the inheritance tax purposes to mitigate that and kind of gift shares to your kids and stuff like that. We did speak up quite a bit about that as well. So that was really interesting.
Yeah, so it's always a hot topic, guys. Should you invest in a limited company? We will cut to the interview with Liam from GetGround. Here you go. Welcome to the Scottish Property Podcast, Liam Rogan from GetGround. How are you today?
Grand, thanks. Thanks so much for having me on, Nick and Steve. It's
thanks for joining us, Liam.
Pleasure to be here. Thank you.
So it is a hot topic. It's been a hot topic for years, but we're talking about, limited company, buy-to-let investing. You guys kind of specialize in that for landlords. Just tell us a little bit quickly about what, your company GetGround does and how they can help buy-to-let landlords.
Yeah, for sure. So, and as you said, it's been a super hot topic in the industry for the last 5 years or so. And despite it being talked about so much, there's still so much confusing information out there. Every new landlord or even novice landlord, and even some advanced landlords have a million different questions. Do I buy this in my personal name? Do I buy it in my company? If I buy it in a company, where are the upsides? Where are the downsides? Whatever there might be there. And so some pretty intrinsic and challenging tax questions as well. And so despite how much information there is out there, it's really hard to get a plain and simple answer in sort of language you understand. So, you could be the cleverest person in the world, but the minute you start throwing tax jargon and things at people, it can become really, really confusing. And so at GetGround, we basically specialize in everything related to limited companies. And the first big thing we try to do is be an educational resource. So all the consultants here and all the team members here, their goal is to teach people and help them understand whether a limited company would be beneficial for them. If it is, why is that? How do they access those benefits? How do they mitigate potential downsides and make the most informed decision going forward? So we're basically trying to take that complex tax and structuring information regarding limited companies and make it really palatable and really easy to understand. And so what we do with all our partners around the world, be they mortgage brokers or accountants, we sit down with their clients, usually over Zoom, help them figure out which route's best for them, understand the ins and outs of limited company investing versus doing it in your personal name or doing it in something else, and help them make the best decision going forward. And then the second arm of what we do is we've created a very impressive end-to-end service for that. So we've created a tech-led service for it. So anybody who wants to go down the limited company route, what we do is we set up and structure the company for the individual. We make sure it's set up in the correct way, so that's built for buy-to-let investing. So it's tax efficient, it protects the shareholders, it has direct to loan agreements, shareholder agreements, things like that. Then we automatically even open the company's business account so that you don't have to go to the bank and wait a month and endless calls back and forth. And then we manage the company. So we take away all the hassle related to running it. So all of the accountancy, the tax filing, the bookkeeping, the registered office, everything you need to do to run a company, we bring under one roof, make it really, really efficient and really, really accessible so that you don't have to go between a load of different partners. And we also make it very cost effective. So the three sort of big issues we saw in the marketplace was that there's a real lack of understanding. And we wanted to solve that by becoming a really strong educational entity and really understanding the ins and outs of this and make it very palatable. We wanted to remove the hassle associated with going that route. So, bringing company formation, accountancy, bank accounts, registered office all under one roof, and then remove the cost. So one of the sort of prohibitive factors people often find about going down the limited company route is that it can be quite costly. So, the sort of industry standard for even sort of one or two properties is about £1,500 a year in accountancy costs, which is a huge amount to pay, especially maybe if your tax savings are only £800 or £900 a year. So we wanted to remove that and make it really accessible to everyone. So we charge £20 a month to run the company and basically bring it all under one roof and make it very accessible.
This is such an important topic as well, because when you start investing in property, I think it's so important to kind of think of the exit plan and the entry level. You always just go in and go, okay, I'm putting an offer in, I'm going to get a buy-to-let property, but just don't think of the kind of long-term implications. What's the long-term plan? What's the growth? What's the exit plan at the back end? And I think that's where probably people, obviously the tax changes as well, like Clause 24 has probably not helped that, but a lot of people kind of jump in and then, I'm assuming a few years down the line, go, oh shit, I've made a mistake. I shouldn't have really bought them in my own name. I now want them in a limited company. And I suppose that's causing a lot of complications there, isn't it?
Yeah, it's a massive part of it. And people forget how long-term an asset class property is. It's very rare somebody, unless you're flipping a property, it's very rare anybody buys property for 3 years or 4 years or something like that. In fact, some people even buy the property 3 years before it's even been built with off-plan stock and things like that. And so I think the average period of time somebody holds an investment property is close to 10 years. And there's a lot of people who'll just hold it forever. So you've really got to understand every stage of the process from, the buying stage, the ownership stage, and then the exit stage, and sort of counteracting anything that might hit your profits and your returns within that period.
Mm-hmm. See, whenever we see this question, and it's always one of the biggest questions that anybody asks me, the first question when I start out in property and they get an idea that, things have changed with Section 24 and the tax changes and that, they always say, should I be investing in buy-to-let in the limited company, right? Which we've talked to accountants before, and we always get the same answer. It really depends on your individual personal circumstances, right? But maybe it'd be easier just to say, would there be a typical example of somebody who shouldn't go down the limited company route? Is there any kind of idea who shouldn't be doing it?
Who shouldn't go down it? Yeah, that's a really good question. It's a lot easier to say who should. I think a big part of the reason why more people are going down the route is, yes, certainly certain tax changes have helped promote that, but also people's sort of mentality of realizing what they're doing with property is you're running a business, and even if that's one property, it's a cash flow and cash generating business, and you would put any other business in the company for the efficiencies and the management efficiencies that also come with that, and so it makes sense for property. So I think that's been a big part of the reason why people are keen to go down that route. And there probably are a few people who, or a percentage of investors who shouldn't go down the limited company route. I think a good example would be maybe somebody who is retired and they might have had, let's say, 40k lump sum from their pension when they've left, and they might have a very modest pension as well, so they might have a total yearly income of, say, something like 15, 16, 20,000 pounds, something like that, and the mortgage products for them aren't particularly attractive. So obviously one of the one of the sort of more challenging parts of limited companies is that the interest rates on the mortgages can be a bit higher. So if you're investing there, you've got a very low income, and let's say in that scenario you maybe don't have children, and what you might consider in that position is, the differences between personal name and limited company would be a lot less substantial there. So you may be better in a personal name, you may be better in limited company, but it would probably be a marginal difference. So I would say retired person with not a great deal of cash, relatively low income, and higher interest mortgage rates and no kids, so they don't have to worry about inheritance tax and things like that. It probably makes relatively little difference. So I think that's a pretty good example of them.
I guess at this stage, we should say that none of us are qualified accountants. This is not tax advice. So we're just having a general conversation. Like myself and Stephen can bring our experience in. Obviously, Liam sees these kind of questions day in, day out from the clients at GetGround. So, always speak to somebody about individual circumstances. But just in general, I often kind of pick up from different sources that, if you are a lower rate taxpayer and you maybe don't have that ambition of growing a big portfolio, then sometimes it really doesn't make sense, because you do get, once you come to doing your tax return, that you get like a 20% credit or something like that put on your interest. So really you're not much better off. But in the higher rate tax bracket, as a general rule of thumb, then it's definitely usually worth considering.
Even on the lower income tax side of things, on the sort of basic rate of income tax, I think one of the things people also need to understand there is where you might be in the future. So what's quite common is you'll have, say, let's say somebody in their late 20s, and they've saved up some money, or they've got a cash injection from somewhere, inheritance maybe, or something like that, and they're trying to figure out which way to invest. They're buying a property. Now, right now, they're a basic rate taxpayer, but in 2, 3, 4, 5, 6, 10 years, will they be? And you've really got to plan for your future. So if you're in an industry where there's a very strong chance that you're going to be taking over that tax bracket, you've got to think about what the future scenario might be. So initially, the differences in your kind of post-tax profits might be sort of fairly the same. You may even be slightly worse off the company. But as we know, transferring property in a limited company further down the line can be very, very challenging. So it's something you've got to decide on at the start.
And costly.
Costly, challenging, and not right for a huge amount of people. So it's worth considering the long term, figuring out, are you going to hold this property for a long time? If it's a short time, and if you're a basic rate taxpayer and you only care about the income from it, maybe it isn't right for you at that point. But the other thing people also fail to consider sometimes is the inheritance tax implications. So you may be a lower rate taxpayer, and the difference between sort of the cash flow from a personal versus limited company perspective might be sort of fairly marginal. But a lot of people are building up an estate to pass on to their kids. They want to pass down some properties to their kids and make their life a bit easier on the exit. And inheritance tax in the UK is very, very high. It's at 40%. And so you've really got to consider what you're going to do before that happens, because one of the intrinsic benefits of using a limited company is that you can very tax efficiently transfer your property to your children in a way that you can potentially mitigate inheritance tax. And so that's something to really keep in mind when you're doing that as well. But there's a number of different factors, and that's exactly what we try and explain to people when we're dealing with them, try and make it suitable to their own situation, help them figure out what they want out of it.
On that, someday there's a good time to kind of discuss that, because it's probably one of the most kind of common questions that people have bought a few properties in their own name, and they're now thinking about transferring over a limited company. And now I know myself, I looked into it personally, and I've been selling them off for the last 4 years in my own name to use my capital gains almost every year rather than transferring them over. But could you kind of answer that? And I know it's going to be very specific to each individual person, but what's the method of transferring it between your personal name to a limited company, and what's all the cost implications involved in it?
Yeah. So it's like you said, it's one of the biggest questions going. So when Section 24 came in, a number of other tax changes like that, and there was a huge sell-off in the market, so people just decided this wasn't worth it for me. A lot of people stomached the blow, and a lot of people tried to figure out how to transfer them across. Now, if you simply want to transfer your property from your personal name to a limited company, logistically, it's very easy, because essentially what you're doing is you're selling that property to your company. Now, the annoying thing with that is that when you sell to your company, even though it's essentially going from yourself to yourself, or at least you perceive it that way, it's going from one legal entity to another legal entity. So HMRC views that as a sale. And so what it usually incurs is stamp duty, land tax, because that's due on any sale of that nature. But it also likely will bring in capital gains tax. So if you've held those properties for a certain period of time, you're likely to pay capital gains tax and stamp duty, land tax on that. So a lot of people are faced with quite a challenging position there. So do the tax efficiencies and the benefits of putting my properties into a company outweigh that initial hit? Now, there are ways to mitigate those taxes. But the issue is, I think the internet does quite a poor job of explaining these and explaining the accessibility of these. To put it simply, that the government hasn't made it easy to transfer these across. If they did, and if there were all these routes available, then everybody would be doing it. But the reality is, for I would say 90+% of people, it's very, very challenging to. Now, the routes, the two sort of common methods that tax advisors try and get people to go with is the first one being they get something called Incorporation Relief, which basically means that you can potentially mitigate capital gains tax. And this is basically promoting the argument that I've been running my properties as a business. So I've been, visiting the properties, I've been managing the tenants, I've been doing, whatever might be related to running that property as a business. And theoretically, you can transfer those properties into your company and mitigate the capital gains tax because you can prove that you've been running this as a business and that you deserve that relief. Now, the challenge with that is it's quite difficult to prove that you've been running the company. Running the properties. So if you're using a property management agent, well, you clearly haven't been because they have been. And there's certain sort of debates about doing either 10 or 20 hours work a week on those properties. And things like that. So it can be challenging. Now, a tax advisor can give you a much more thorough sort of overview of that side of things, and they'll be the ones who assess your situation and figure out, do we have a legitimate argument where we can go to HMRC and say we shouldn't be paying capital gains tax on this transfer. And that's why tax advisors can be great, because they will give you a pretty solid answer because they're not going to waste their time going to HMRC on a failed cause, essentially. So I think
anybody that's not familiar with the jargon, because we do have people starting out as well. So the capital gains, can you just quickly explain what the capital gains tax is?
Yeah, so when you buy a property or buy any asset, if it increases in value over time, and then you decide to sell it further down the line, you typically have to pay tax on that. It's called capital gains tax. So your asset has grown in value and you have to pay tax on that. Now, the good thing is you get a capital gains tax allowance per year. I think it's 12,500 at the minute per person. But anything over that per year, you have to pay capital gains tax on it. Now, there's different capital gains tax on things like shares. There's different capital gains tax rates on property and other things like that. So if you take a very simple example, let's say we've got a £200,000 house that we buy, and then 10 years later we sell it, but it's now worth £300,000. If it's just us owning it, when we sell that, on that £100,000 of gain, we get £12,500 of that untaxed. And the other 87,500 of that gets taxed. And it gets tax related, and it's related to your income tax level and things like that. And so it can become a bit complex there, but it's basically a tax on the gain in the value of that property.
Yeah. And I have heard, obviously, like you said right at the start, people, being able to kind of mitigate that level of capital gains tax when they're transferred. Another thing that we hear quite commonly in Scotland is people might have built up a small portfolio in their own names, and now they're looking to expand that portfolio. And, they definitely think that the limited company route is the one that they want to go down. And a number of people that I've spoken to seem to have been able to in Scotland, we have a thing called ADS, Additional Dwellings Supplement Tax. It's 4%. And this was something that apparently if you have like 6 properties or a portfolio, then you can avoid that. I don't know if you've heard of any situations there.
So I'm not 100% sure on the Scottish side of things because we've only just started operating in Scotland very, very recently. I know in the UK, with regards to the incorporation relief on the capital gains tax side of things, a lot of tax advisors ask that you own a minimum of 5 properties before considering it. So they want sort of a portfolio of 5 or more because they believe those are the most likely ones to mitigate the CGT. Now, the ADS, I'm not 100% sure on. I know in England, stamp duty land tax is the big one. And you can mitigate stamp duty land tax sometimes if you qualify for what's called a partnership. So if you hold your properties in partnership with somebody else, you can potentially mitigate the stamp duty land tax. So I'm not sure if the ADS one is similar to that.
Stephen, have you heard about this one?
Yeah, that's very similar. Yeah, that's what I've heard with the partnership agreement. You were explaining there before about the kind of, you're going to pay that you can mitigate the capital gains tax if HMRC deem that you've been running it as a business. But I'm assuming on the buy-in side of it, through buying in your limited company, you wouldn't be able to mitigate the additional dwelling supplement or the land stamp duty and land tax.
As in mitigate it if you're buying it. So do you mean transferring into a company or buying
transferring from your personal name to your limited company? Because then obviously technically you're buying it in your limited company but selling it in your own name.
You are, but in those situations, that's where partnerships come into play. So,
right.
So I think if you own your properties jointly with somebody else, or you have a business partner, or you set up a partnership and I think have it for 3 years or so, then you can posit a fairly strong argument to HMRC, and your tax advisor will give you more some insight on that. But I know the tax advisors we worked with before have asked that the people who we've sent over have a minimum of 5 properties, and they own it in partnership with somebody else, because those are the most likely routes to mitigate the cost of doing that.
Yeah, makes sense. And so is that one of the more common routes then? Because I think you said there were 2 common routes of transfer in between your.
Yeah, they were the 2. So there's the partnership relief and the incorporation relief. So the capital gains tax side of things and the stamp duty land tax side of things.
Mm-hmm.
But again, sorry a second.
Sorry, so it's not as quite kind of straightforward as it is. It's basically selling the assets in one name and buying them in the other name, and there's quite a lot of considerable cost to consider if you can't mitigate these.
Precisely. What some people will do is they'll transfer them. It sounds actually a bit like you're doing that actually. So that they'll transfer maybe 1 property per year to use up their capital gains tax allowance. So maybe they don't qualify for the incorporation relief or something similar. And so to mitigate that capital gains hit, as long as there hasn't been huge amounts of capital gains on the property, they might use up their allowance per year. So they'll transfer 1 property per year, use up their 12,500. If they own it with somebody else, that'd be 25,000. So you can certainly mitigate things there. But the reality with all this is certainly the question we're asked most is for 90% or so of people, it can be really, really challenging to do that. And if it wasn't much more, many more people will be doing it than they already are.
I'm assuming there's quite a complex issue with lending then, because obviously if you've got a mortgage on the property in your own name and you're transferring it to a limited company, I'm assuming that adds another layer of complexity as well.
It'll certainly add a layer of complexity. It isn't massively challenging from a technical perspective. I mean, if you think with a normal sale, that would be fine as well. So if you set up a limited company and you're buying a property into it from somebody else, that mortgage process is really simple. So the mortgage process isn't massively different on this side either, because you are still buying it. It can be costly, so you obviously need solicitors on both sides. So selling solicitors and buying solicitors, and then there's mortgage fees and things like that. But it's certainly not a colossal challenge.
So is that something you can help with then? So if somebody's in that position where they just don't know whether it's the right route, and can you actually get one of your team to sit down with somebody and then figure out exactly the cost then and if it's beneficial?
We can certainly give people guidance with that. We're not tax advisors ourselves, so we have tax advisory partners who do the real sort of deep dive into that, and we suggest that absolutely everybody gets tax advice. I mean, you're playing around with big pots of money here, and you'll be amazed how few people actually get professional tax advice, and they really should do it. So we give a really good comprehensive overview and help them understand the ins and outs, and a really deep and thorough education. But it's vital that you go and get tax advice with this kind of thing.
One of our listeners listened to a presentation that you guys did, I think just recently at a Glasgow property networking event, and they were asking me to ask you, when they saw we're having you on as a guest, about their understanding was that you pay the subscription, whether it was per property, but each time you buy a property, I don't know if they misunderstood, but their understanding was that it was a different company each time.
No, their understanding is correct. So we do something quite unique. So we put a limited company or an SPV around each property that's purchased onto the platform. Now, the reason we do this is that it's actually one of the most tax efficient and lucrative ways to actually own property in a limited company. Now, until recently, it was fairly challenging to do that. Because if you think what a typical, accountant charges, £1,500 a year for one company, and the hassle and the sort of archaicness of that, it would be very hard to replicate that. So if you had 3 companies, that would be like £4,000 or 4,500 or something like that. So until recently, it was very difficult to own in separate SPVs and in separate entities. Now, we designed our product and our platform to be able to, give people access to that very, very simply. Now, and very cost effective at the same time. Now, the reason it's beneficial is, kind of 4 or 5 principal reasons. But the first one is that when you come to exit the investment, one of the traditional downsides of using a limited company is that you don't get your capital gains tax allowance, or at least you don't get it immediately. So traditionally, if you have a limited company, you want to sell your property, you're going to sell your property out of that limited company. Now, when you sell that out of the company, you're going to pay corporation tax on any profits. Now, at that point, you don't get your capital gains tax allowance. After that, you have to then figure out how you get that money out of your company. So you've been taxed once. Now you've got to get it out again. So you're going to get taxed again. So you're either going to liquidate that company and pay capital gains tax on it. But if there's other properties in that company, it's going to be very hard to liquidate because you'll have to sell everything. Or you're probably going to dividend that out of the company. So you're going to pay yourself a dividend from the company. So you can pay really, really high tax on exit. And this is one of the traditional downsides of the company route. Now, one of the core reasons we put each asset in each SPV is so that when you come to sell, you can actually sell the property by selling the company's shares. So when you sell the property by selling the company's shares, you're still selling the property, still list it, the buyer would still come and visit it, things like that, except now it has this wrapper around it, and that wrapper is the company's shares. Now, when you sell that way, you elicit 2 principal benefits. The first is that the incoming buyer doesn't pay stamp duty land tax on that. So you have a price advantage. So they pay stamp duty instead of stamp duty land tax, which is substantially lower than stamp duty land tax. So let's say a buyer was going to pay £30,000 in stamp duty on a purchase. They're no longer paying that. So you as the seller could increase the sale price of that property by 15%. So sorry, by 15,000. So you meet in the middle. So the buyer gets a pretty substantial discount, and you on the exit get a pretty dramatic uplift in the property profits. Now, the secondary element of that is you get your capital gains tax allowance now, because you're selling the property by selling the shares. And so you're paying capital gains tax immediately. But the other benefit here is that you pay a substantially lower rate of capital gains tax on the sale of shares than you do on the sale of property. So not only are you actually increasing the sale value of your property through your stamp duty land tax advantage, but you're actually minimizing your capital gains tax as well. Add into that, that's also a much easier sale when you sell the property by way of the SPV, because it's information rich. You can prove by that, by the company's business account, the rent that's been going in for the last 10 years. You can prove the property management costs. You can prove everything related to that, because it basically has a financial history and a legal history. And so it's very easy to sell, and it's very lucrative to sell that way as well. Now, if you hold all properties in the same company, it's very hard to sell the property by way of selling the shares. And so that's one of the core reasons why we separate it out into separate entities. And one of the other core elements of that as well is down to liability. So if you put all your properties in one company and something happens to one of them, let's say, I don't know, tenant trips in one, breaks a neck and sues you or something like that, all the assets in that company are at risk. Now, when you separate them out into separate legal entities, they're legally ring-fenced from each other. So there isn't a domino effect on them when that happens. And so that's another one of the core reasons we do it. There's also pension benefits to doing it that way. So you can maximize your pension contributions from your company and a number of other things like that. And because we can keep the cost down to just £20 a month, it makes it very accessible to own that way.
So it's £20 per month per property, per company.
Per company, yeah, essentially.
So what happens if you have 20 properties, then you're going to have 20 different limited companies? To me, that just sounds like an absolute administrative nightmare. I mean, do you have to open up 20 different bank accounts? Do you have to, how does that work?
Yeah, precisely. But the entire platform's been designed that way. So we've got a team of just close to 100 here, of which probably 30 to 35 of them are actually the tech guys, the designers, the programmers and everything. And the platform's been built so it's really easy to do that. So it's not any more of an administrative nightmare than one would be. So remember, we're doing all the work for it. So all the administrative burden's done by us. The accounts are open separately, but they're opened automatically on the platform. So you don't have to apply for it or anything. You're just clicking a button and it opens. And everything's run by us. The whole purpose of the platform is to make owning in separate entities really, really easy. So accountancy in the UK is archaic. It's really old school. It's really slow. It's laborious. And it doesn't allow options to, well, basically only a separate SPVs very, very easily or very cost effectively. So additionally, you mentioned, what if you own sort of 20 properties in 20 companies? Well, charging £20 a month for each of them would be really quite expensive at that point. So once you get to, I think it's 8 properties, we have custom pricing comes in, so that you don't end up paying 50 times 20 a month for, say, 50 properties or whatever it might be. So they're in line with sort of the market at that point, except the difference being that you now have the benefits of owning in separate SPVs.
Okay, interesting. It's just one of those ones where it's probably, like you say, the tech kind of kicks in, and then that's where obviously things become manageable, because you need to get your mindset out of like all this different stuff that you would traditionally do. But this is where presumably your platform takes away all that work.
Precisely. Yeah, that's the whole person. I'll have to show you guys and anybody listening sort of a demo of the platform so you can see what we're actually talking about there. But the way you would actually view it on the platform is try and remember, or try and think of it as if those companies aren't there. You just have your properties listed on the platform. They have to file accounts each year. They have to provide confirmation statements each year, except none of that is being done by yourself. That's being done automatically by us. Same with the accounts.
What about the bookkeeping? So what about the bookkeeping side? Do you do that as well?
Yeah, that's something we assist with. So you would simply upload your receipts to the relevant property, invoices, things like that. On the account, so you just log into your account, you click the respective property and upload the invoice for that, the mortgage standing order, whatever it might be, set up a standing order for that property from that account, and go from there.
Does sound really interesting. I'm assuming from your side, Nick, as a letting agent, if you're the landlord with 10 properties, each individual rent would be paid into separate bank accounts for those individual properties.
And that's one of the actual sort of intrinsic benefits of it. So if you say, let's say you have one company with 10 properties in, you've got one big cash flow coming in, got one big cash flow coming out. It's quite difficult to figure out what's actually going on in there, what's working for you, what's not working, what services need changing, what's not performing for you, what rents can increase, do I need to refinance, remortgage, whatever it might be, because it's just so much information there. So what we're trying to do is allow you to have the macro of that so you can see everything coming in, but also see the micro of it at per property level, because it's broken down, because each property now has its own cash flow coming in and its own cash flow coming out.
What happens if the person who was buying the property at the back end, instead of buying the SPV, they've already got their own company? They're buying a new company rather than a property add to their company.
Well, they could do either. So they could buy the SPV into that. It could be a subsidiary of that company, or they could just buy the property into it. So you're not reducing your options, you're just increasing them. So you can still go the old route and sell the property from the company, but you can now buy the SPV as well.
Mm. It's going to be the buyer's discretion.
Precisely.
Which is easy for them, yeah. Mm.
Precisely, yeah.
Can we just talk about, you're talking about from the letting agency point of view there, Stephen. I'm just thinking, if somebody came to me and every time they bought a property, it was like I had to reset up all new details every time for a different company, different bank account. That is, but I guess, at the end of the day, you just need to go with what the client wants. Do you know what I mean?
Yeah, exactly. I mean, so the letting agent is, first of all, the client's discretion. It's also worth mentioning that 90% of landlords in the UK never own more than 2 to 4 properties. And so if it's not really that hard to do it for 4. Most people, the remaining 10%, don't own over 6 or 7 ever. Yeah. And even at that rate, yes, there are 2% who own 10, 15, 20 properties, whatever it might be.
So would you say that your model, your business is aimed more at those kind of small landlords, or can it still work for like bigger portfolio landlords?
Definitely works for bigger landlords. So we've got currently about 8,500 landlords using us on the platform. So we've got 8,500 users on the platform right now, and around the globe. So we've got 5 offices. We've got London, Hong Kong, Singapore, Lisbon, and Berlin. And we work with some pretty big names who have referred those numbers over to us. But those who are on the platform own everything between 1 property and 20, 30 properties. And lots of those 20 or 30 are in companies on the platform. So we've got a real mix of people. Admittedly, we probably have a lot more novice investors. And the reason being is because we set the companies up ourselves and then run them. A lot of your more established landlords have already set up companies that already have their own accounting firms and things like that, and they're happy to stick with them, and that's completely fine. But yeah, we have landlords of all shapes and sizes.
I'm assuming changing your mind as a seeing the benefits of what you guys provide, and if someone has already got 20 properties to then set that up, I'm assuming that'd be probably a bit of a minefield, and removing each individual property and set up their own company for it and putting them in that.
Exactly. Currently, we don't actually bring on existing companies. They're only companies set up on the platform. So one of the core reasons for that is, so share sales are great. So selling property by way of share sales is great. It's very efficient. It's very tax efficient as well. There's a lot of information. It can be a lot more smoother than typical process. Now, one of the typical hindrances to a share sale is trust in what you're buying. So if you're buying a company with a property in it, or multiple properties, or whatever it might be, you've got to do a lot of work to make sure you know exactly what you're buying. Am I buying a company with employees? What's the debt situation here? What's going on in this company? Who are the owners? Is it a company behind a company behind a company behind a company? And you've got to do a lot of due diligence, and it can be quite a scary process, and it can be quite a costly process. And so that's one of the traditional downsides of selling that way. Now, the reason we currently don't bring on existing companies is because the companies we set up and at GetGround are structured in a very high caliber way, so that they're super transparent and super easy to sell on exit. So they basically have a brand, as it were. So people know GetGround companies in the industry. Mortgage lenders know them, buyers know them, sales know them, our agents that we work with know them. And it allows for a very trust-built sale, essentially. So you know exactly what you're buying. You know this company has never owned any other properties. It's never employed anyone. It's never done anything different. It's never traded or anything like that. And it allows for a super efficient sale on exit, and as well as a super efficient management of it as well. Now, when we take on existing companies, we basically can't provide that seal of guarantee. Now, we are working on ways to figure out routes to that. So in the coming year, we will be able to bring on existing companies, and we're figuring out routes to that. But yeah, right now it's people buying new properties that we take on.
I suppose it all goes back to what we spoke about at the start there as well. Like it's having your exit plan, in your mind, a bit of a game plan in your head when you're starting out on this journey, because if you were going to exit them in 10, 15, 20 years time or staggered, then it makes sense to do exactly what you're talking about.
Precisely, yeah.
And does it work for like overseas landlords as well, so non-resident?
Yeah, massively so. So I would say that of that 8,500, we maybe 30 to 35% are overseas. And so you would have a clump of those would be expats. And then a lot of those would be foreign nationals. So like I said, we've got international offices, and we have a lot of clients from the Middle East, a lot of clients from the Far East, and an increasing number from Africa, actually. So we have a lot of South Africans, Kenyans, Nigerians, people like that. We've started to do some more in America. And Brexit's messed things up with sort of the mortgage point of view for Europeans. So Europeans aren't investing in UK property much at the minute, but we do still deal with quite a few Europeans as well.
And just to kind of, we touched on it earlier, just about the benefits, and limiting your tax liability and all the rest of it. I think we could just finish off with some other kind of benefits of investing in a limited company for listeners, because, you touched on looking at the kind of end game and the exit, and if you've got kids, passing on to there. So let's just talk about that, just briefly again. So, I'm in this position. I've got 3 kids, Stephen as well. Eventually you don't want them to be lumped to you don't want the government to be getting 40% of what you've taken years to build up. So what are you aware of what the what's the threshold again? Was it 350,000 or something like that for the inheritance tax or something?
I think it's 325.
Right.
I think 325. So the general logic is that for most people, their principal property that they live in ends up taking all of that. So any additional assets, be they property or anything else, are usually hit by a full whack of stamp duty. Obviously, people's circumstances are different, but that's a very common scenario. And one of the really advantageous parts of using a company is that you can potentially mitigate inheritance tax. So what you can do when you buy your properties into a company is, over time, you can gift shares in that company to your kids. Now, you can gift property to your kids as well. That's not something that's particularly hard to do. The challenge with gifting property directly to your kids is you can't gift part of a property at one time. You got to give the whole thing away in one go. Now, when you give it all the way in one go, it obviously has some tax issues there as well. But the biggest problem for you, especially as you're getting older in life, is that you lose control of that. You lose control of the income, you lose control of everything that's going on with that company. And the other problem with it as well is for inheritance tax to be mitigated, you have to make the gift 7 years before passing away. Now, it's pretty difficult to know when you're going to pass away. Now, you can obviously make some judgments. You can say, well, I'm 50 now, so I'll probably be fine in 7 years, but you also don't know. And so what you might do to mitigate that is you might give your property away much earlier to your kids. So you might say, oh, I'm 65 now. Hopefully I'll be around in 7 years, but just in case, I'll pass it away to the kids now. Well, that's great. You've passed it away to your kids. You might mitigate, so your kids might mitigate the inheritance tax. But the challenge you now have is that thing you've built up for your retirement as well, and it's a really core part of your retirement. You now can't take the income from because it's now in your kids' hands. You've also given 20-year-old Billy your house, who doesn't know how to brush his teeth in the morning, let alone run a property or remortgage one or whatever it might be. So you're in a challenging position there. So what a company's really good at doing is separating the control and the economics of the company. So as time goes by, what you can do is you can gift, say, 10% of the shares in that company per year to your kids. And we've made that really easy on the app. So you can, on the platform, you can just click share transfer, gift it to Billy, give him 10% per year. But as long as you hold the directorship in that company and still have some shareholding, you're the one in control. So you decide what happens to that income. You decide if it's paid into your pension pot. You decide if it's taken out by dividends. You decide if it's part of your direct loan repayments. Billy can't really do anything. He's just a shareholder in the company, a bit like, you might hold shares in Apple, but you can't decide, what happens with that company at the minute. So as long as you maintain the kind of directorship and some shareholding in that company, you can gift as much of that away. And the good thing with that is you can gift it away far in advance of potentially passing away. So you could potentially start doing that, when you're in your 50s or early 60s.
And what age do your kids have to be before you can start gifting them shares?
So I forget what they officially have to be. What you'd have to keep in mind is the mortgage. Lenders don't accept shareholders under 18. Business bank account providers don't accept them under 18. To my knowledge, lenders also typically don't want them to be under 21. So I know there's lenders who are okay with 18, but 21 seems to be the safe age. To my understanding, you can obviously give the shares across to your kids, even when they're younger than that, but the actual benefit of doing that is going to be quite challenging from the kind of more.
And I'm assuming you'd have to then assess the value of the company each year. If you were giving away, if the capital gains allowance was still at £12,500, you have to kind of look at the shareholdings that you're going to give away 1 or 2% and make sure it's no greater than the £12,500 capital gains last year to try and
precisely. And that's another benefit of the company route, is because you can do 10% per year or 5% per year or whatever it might be. And there are also other things you can do in terms of slightly more complex setups, so alphabet shares and things like that, so that you can sort of mitigate inheritance tax and reduce and change dividend rights and things like that. So there's a lot you can do there to mitigate inheritance tax, and it's a massive part. I mean, I think the government did a study a few years back, and the principal reason people were building portfolios of property were for retirement and for estate planning, so passing it on and living off in retirement. So it's super important that you might be 40 now and 15, 20 years off retirement, but you want to make sure that when you get there, your structure's right so that you can live efficiently, essentially.
Yeah, and you were mentioning earlier on about kind of having the controlling aspect in the business as you pass them on. What happens when your child becomes the majority shareholder? Then are they not automatically kind of the deciding factor? They have the last say.
Yeah, it's a challenging one. I'm trying to remember what the actual boundaries are. If it's 20-25% shareholding, you need to have, or whatever it might be. The reality is most people don't. So obviously your structure does matter, but most people's children aren't keen to mess them around or anything like that. So, even if you are a 90% shareholder as a child and you as the parent are a 10% shareholder, but you're a director, it's fairly unlikely your kids are going to try and make you resign as a director. There is the potential for that, and there are things you can do to mitigate that. But it's relatively rare that people would be in that situation.
Could this be where that kind of trust comes into play then, where you can put them in trust?
Yeah, trust is a very common thing. It's not something we deal with ourselves, but a lot of people do use them for reasons of that as well.
So sorry, just getting back to the share things. So I've got 3 kids, right? I give them shares in the company. If I'm doing it through yourself and Get Ground, then I have to do that for each company. What happens when I die then? What happens to the...
Well, it depends how your will is made out. I mean, typically the will is what determines what happens to your estate. And what usually happens, again, I'm no expert on wills at all, but my understanding is most of it passes to your spouse. So if you're married, I assume most of it passes to them, and then that would become her estate that she's leaving behind.
It's something. Do you know what?
One for a will expert.
It's something that I really need to get my act together on and get all this stuff really planned out, because, like, if I died tomorrow,
you're on a bit, mate.
It would.
And you got 2 years to try and get the shareholders there as well.
see, to be honest, if I die tomorrow, like, my wife is left with an absolute mess. So yeah, it's something I definitely, and I appreciate, Liam, it's not something that you kind of specialize in, but it's just a thing for listeners to think about, as it is that I'm thinking about. That sort of stuff must be quite important.
No, massively, and this is the thing, the long-term nature of property is, you need tax advice, you need correct structuring, you need wills and estate planning in place, you need protection, insurance, life insurance, and things like that. And it's something, a lot of, I mean, I'm fairly young myself, but in the next sort of 10 years or so, even I probably need to start considering that to a degree, and because it can really bite you in the back, and that thing you work for your entire life can really be put in a challenging spot.
Right. So thanks very much for everything there. I mean, you've obviously explained about Get Ground, which is really interesting. I'm sure there'll be a lot of listeners, looking at using Get Ground or looking into it. Just if somebody was wanting to make the first steps, what would they do?
Yeah, so please just come to us directly. I'll leave my email and number with the guys on the podcast. Or you can book in through our website. You can book in for consultations, and all the consultations are completely free, and we're happy to have as many with you as possible. So if you want an hour Zoom or 3-hour Zooms, that's completely fine. We're happy to adapt to everything there. If you've already set yourself on a limited company route, you want to get set up, it's same on the website, where we have a get started page there. It takes about 15 minutes to actually design the company. And we're fortunate that we've actually had a lot of backing and support from HM Land Registry, so UK government through HM Land Registry. So we've been able to build our product directly into company's house, so we can set companies up very quickly. The company business account is also set up within 2 days of the company being set up. So it's a really efficient process from start to end for that. But most people want to speak to somebody at the start and have a consultation. So we've got a huge team of senior consultants here in the UK. We've also got, if you're listening from abroad, we've got teams abroad. And if you speak a different language, we also teams who speak Mandarin and Cantonese, things like that. So we're happy to speak to you in your own language there. And yeah, please just book in either directly with me or through the website. But you still recommend that people speak to an independent tax advisor, or is that something that you provide as well? Yeah, so we have partners who are tax advisors that we can refer to, but everybody should do. You really shouldn't go forward in your investment plan without tax advice. It's those people are very, very highly trained. Yes, it might cost you a bit of money. I think that's what puts people off. They say, oh, it's going to be £500 just to chat to this person for an hour, but £500 as part of a £300,000 investment isn't very much at all. And so it's definitely worth considering. Excellent. Absolutely. Brilliant, Liam. Thank you very much for joining us. It's been a great chat. Guys. No, thank you so much. So we'll put your link in the show notes, and thanks very much. Really appreciate your time, Liam. Thanks. Brilliant. No, massively appreciate it as well. And I will give you guys a separate link that is synonymous with the Scottish Property Podcast as well. Excellent. Brilliant. Okay. Guys, thanks so much for having me. So hope you enjoyed that. As always, seek professional advice from a qualified tax advisor or accountant. All that information was from our own experiences, and obviously Liam, who works for Get Ground as well. So we would definitely advise you on that. Absolutely, and something I only really discovered a few years ago was, not all accountants are made equal, and a tax advisor is certainly separate from an accountant. So it is so important to seek the right advice and pay for the right advice. If it's beneficial to your property portfolio and your business, then pay for the right advice, because it could save you a lot of headache and money in the long run. Yeah, guys, so get on the Facebook group, continue the chat, get us on our Instagrams. Stephen Clark, you've joined TikTok now. My God. I do it. I'll evolve or die. Let's get you a few followers on TikTok then. What's your handle? The Kilted Property Man. So
I'm going to put some daft TikTok stuff up with me in a kilt on property viewings, refurbs, all that kind of nonsense.
Oh my God! I hope you're
You
wearing
don't want to copy in your dance, mate.
I hope you're wearing your boxer shorts underneath that kilt. That's for sure.
Feel the breeze.
Right. As always, guys, we're doing our monthly events, first Wednesday of each month, and you might see the Kilted Property Investor at one of these as well. So grab yourself a ticket, £20 a ticket, and we'll see you then. Thanks again.
Thanks, guys.